In this section, we're going to be talking about company valuation, which is obviously the one of the central aspects of any private equity investment, namely at what valuation the private equity fund would make their investment into the company. And so what we're looking at is valuation in this perspective, and therefore the private equity fund are going to be performing their own valuation. And therefore, it's important that the company and the advisor to the company, the financial advisors to the company, also goes through the exercise of performing a valuation, because this valuation is going to be confronted with a valuation of the other side in a negotiation. And therefore, it is important that the advisor to the company is able to perform the valuation using all the different points of view, all the different methods. It's also important that the advisor to the company actually understands the perspective of the private equity fund and the way they would approach the valuation, because it can only be to your advantage to understand how the other side is thinking. And therefore, the most important thing for any advisor to a company is to perform valuation from all the possible perspectives, to understand the approach to valuation for the private equity fund, and thirdly, to perform the actual valuation and the number. And it is not about getting the highest possible valuation number in order to please your client. It is about getting a realistic range of valuation in order to be able to have a proper negotiation which will succeed. And if, of course, during the negotiation the valuation is a good one, a high one, that is all to the best. But any advisor who seeks to acquire the company as a client by producing an unrealistically high valuation is only wasting his time and the client's time. The objectives of Module 4 are ambitious. We start with an overview of discounted cash flow. Then we do an overview of relative valuation modeling. We consider how we can source and best manipulate information for the market for the purposes of valuation. We look at the types of information available and the challenges to obtain it. We then look at a worked example from the CEE-CIS environment, which relates to the difficulty of obtaining information in emerging markets. We then move on to look at the private equity style exit-driven valuation approach, which uses the first techniques that we taught, but in a different way. We then give a worked example of a private equity approach, and finally we make some considerations about forecasting and modeling in private equity. We start by giving an overview of discounted cash flow, which is one of the fundamental building blocks of any kind of corporate valuation. The way we will approach DCF valuation in this module is, firstly, we will consider the different elements that are required in order to build up a DCF valuation. We will then review the theoretical basis for these various elements. And finally, we will consider the structure of these elements and how they fit together. The first thing we need to do is to reconcile valuation techniques with the different points of the life cycle of a company. And we do that in the chart in this slide. The first thing to notice is that the MPT working range, the modern portfolio theory working range, that is the types of typical valuation taught in textbooks, only works in the areas of company life indicated in the chart, from middle of expansion phase to early decline. Outside of these phases, particularly on the left-hand side of the chart, when we're talking about venture and the early stages of expansion, the classical approach of financial theory to valuation does not work, because the company is too young and the company is growing very quickly and the company is changing too quickly for these theories to work. What is discounted cash flow valuation? It's a valuation method used to estimate the value of an investment based upon its future cash flows. What DCF analysis does is that it finds the present value of the expected future cash flows by using a discount rate. The present value estimate is then used to evaluate a potential investment or to express the valuation of a company. What is the discounted cash flow formula? The discounted cash flow, DCF, is equal to the sum of the cash flow of each period divided by 1 plus the discount rate, either the return on equity or the weighted average cost of capital, which is raised to the power of the period number. The DCF formula is shown in the chart. CF stands for cash flow in the period, R stands for the appropriate interest rate or discount rate to be used, and N is the number of periods. The elements of DCF valuation. The chart in this slide summarizes in visual form how we can build up a DCF valuation. Firstly, we start with the discount rate. We need to know the cost of debt and the expected return on equity by equity investors, which are two separate things. The return on equity is composed of a risk-free rate, a market premium, and a beta, and we're going to see that a little bit later. Combining the return on debt and the return on equity, we're able to get a discount rate in order to value the cash flows. So that is one element of the valuation. The second element of the valuation is the cash flow forecasts. So forecasts of the company's cash flows during an appropriate forecast period. And then finally, the terminal value, which expresses those cash flows which are unable to forecast because they're beyond the forecast period, yet they exist. The elements of DCF valuation are shown in the table in this slide. Cash flow forecast, symbol CF, refers to the company's cash flows for the forecast period. Discount rate, symbol WACC, refers to the discount rate which is applied to the cash flow to the enterprise, meaning the cash flows that are both for the bondholders as well as the equity holders. Return on debt, RD, is the required return by holders of company debt. Return on equity, RE, is the required return by shareholders for the shares in that company. Risk-free rate, RF, refers to the yield of a risk-free bond or instrument, which is typically expressed through the yield of a 10-year government bond. Market premium, RM minus RF, refers to the difference between the expected average stock market return and the risk-free rate. In other words, it's the extra return that has to be offered in order to induce investors to invest in the stock market rather than in a risk-free instrument. Beta, symbol beta, refers to the volatility or the risk of a specific share compared to the market average of the shares, and it tends to be expressed according to sectors. Terminal value, T, refers to the value of the cash flows beyond the forecast period. Here let's discuss a little bit the theory of finance. So firstly, let's discuss what we mean about the theory of finance. What we mean by the theory of finance is the concepts of finance which are broadly presented in a typical MBA or financial master's degree course or a typical textbook on finance. And so these are the theories which underpin many of the financial techniques and approaches which we're going to use. And so three parts of the relevant financial theory which are relevant to valuation are what's known as the Modigliani-Miller theory of capital structure. This is a financial theory to do with what is the best combination of debt and equity for any company. The idea being that because debt is cheaper than equity, it makes sense for the company to be financed by debt as well as equity up to a certain limit, when too much debt can create risks for the company. The second part of financial theory that we're going to use is called the security market line, and this is simply a line that you draw which shows that as the risk of a company increases, the return to the investors should also increase. And this is known as a security market line, and we use that to calculate the expected return on equity. And then thirdly, the present value of cash flows. This is simply the concept that a dollar in a year from today is worth less than a dollar today. And so what the theory does is if we have if we're going to get $1 in 1 year from today, we discount that back at a certain interest rate to get us a lower value, which would be, let's say, for example, 0.95. And so that's to do with the time value of money. So these concepts are all found in the classic, let's say, financial textbooks, and this is what would be known as the theory of finance, which we're going to be referring to from time to time during this module. It's important to point out, if we are going to have a practical module, the skill set that is required for any practitioner to perform a DCF valuation, and this consists of 4 main areas. Firstly, research. The person should be able to find the information in order to use that information to create forecasts, to estimate discount rates, and all the necessary variables. And this requires research skills. Secondly, accounting skills. The person should be able to be comfortable with manipulating income statements, balance sheets, and cash flow statements in order to generate cash flow statements that are correct. Thirdly, finance. The person should have a sound understanding of the financial theory underpinning DCF in order to make the correct assumptions. And fourthly, Excel modeling skills in order to be able to construct a financial model in a coherent way to make it useful, practical, and robust. Considering the optimal capital structure in this slide, which is referring to the Modigliani-Miller theory of finance, what this expresses is the fact that a company has to achieve an optimum balance between debt and equity in order to minimize its cost of capital and consequently maximize its share price, if we consider that capital is an input into the company just like raw materials may be. And if we consider the effect of leverage on the company, so the effect of the company's debt, as the company increases its level of debt, the return required by shareholders, expressed as KE, remains quite flat for quite a long time and only starts to climb significantly once the company is reaching a point of potential financial distress. With the cost of debt, we also have a similar position where the cost of debt remains relatively fixed and then starts to go up fairly quickly as the company's debt levels increase. And if we combine the cost of debt and equity into the weighted average cost of capital, because debt is cheaper than equity, what we see happening is as the leverage moves away from 0 and starts to increase, the weighted average cost of capital, which means the combination of debt and equity, decreases up to a point where the increased debt is having an effect of increasing the company's risk so that the weighted average cost of capital goes back up. And what Modigliani-Miller argue is that there is a leverage point where WACC is minimized and the share price is therefore maximized. The main problem of the theory is that there is no actual calculation methodology to work out what that leverage ratio is. And typically it will depend on the sector the company operates in. There are quite a number of factors which will affect the capital structure, and let's go through these. Risk of financial distress. As the company runs a risk of financial distress, it will no longer be able to increase the level of its debt, and therefore its capital structure will reduce the level of debt to equity in order to mitigate this. Taxes. Debt is tax deductible, and therefore increasing debt as an alternative to equity, because it's tax deductible, will have the effect of lowering the tax bill. Reserve debt capacity. Any prudent company will try and keep some dry powder or some ability to borrow more to deal with unexpected consequences, and this will have the effect of reducing the debt equity ratio. Effects on stakeholders. If the company is, for example, running the risk of financial distress, this will impact employees and the wider community and other stakeholders, and therefore it will impact the debt equity ratio. Dividend and financial flexibility. Financial flexibility means the ability to borrow more, and this will also affect the capital structure. Competitive position. If the company has a strong competitive position, it may be able to have a higher debt equity ratio if the banks are more willing to lend to it because they know that. Agency costs. This refers to the costs of intermediation and administration to do with borrowing money or raising equity. Rating requirements. Often companies will be rated by rating agencies, and this will have an impact on the cost of their debt and the amount of debt they can raise. regulation, there may also be regulatory issues affecting the capital structure of the company. For example, in the banking sector, this is very much regulated.
Question 1. What are the elements of the discounted cash flow DCF valuation method? A. Cash flow forecasts. B. Discount rate. C. Excel modeling. D. Finance.
What is WACC? Companies often run their business using the capital they raise through various sources. These include raising money through listing their shares on the stock exchange, equity, or by issuing interest-paying bonds or taking commercial loans, debt. All such capital comes at a cost, and the cost associated with each type varies for each source. WACC, or weighted average cost of capital, is the average after-tax cost of a company's various capital sources, including common stock, preferred stock, bonds, and any other long-term debt. In other words, WACC is the average rate a company expects to pay to finance its assets. Since a company's financing is largely classified into two types, debt and equity, WACC is the average cost of raising that money, which is calculated in proportion to each of the sources. This slide shows the formula for calculating WACC. As we can see, WACC is equal to debt divided by equity plus debt, multiplied by the cost of debt, multiplied by 1 minus tax rate, plus equity over equity plus debt, multiplied by the return on equity. Please watch the video to get a little more detail. Why is WACC important? Well, maximizing the value of the company requires minimizing the costs of all inputs, including capital. Capital budgeting decisions require an estimate of the cost of capital in order to calculate the NPV of any new project the company may be considering. And valuing companies and valuing the equity of those companies requires an estimate of the cost of capital. Cost of equity, RE. The cost of equity is calculated based upon the premise that the company should earn a return on its equity of at least as much as its shareholders could obtain on alternative investments of equivalent risk. In other words, the cost of equity of company A has to be similar to the cost of equity of company B or C if those companies are direct competitors of company A. Otherwise, investors would go to the other companies if they offered a higher cost, a higher return on equity. RE can be used using the capital asset pricing model and alternatively the dividend valuation model. What is the capital asset pricing model? It's usually expressed as a graph with the x-axis being risk and the y-axis being return. And the idea is the higher the risk, the higher the return should be. CAPM is a model that describes the relationship between the expected return and the risk of investing in a security. It shows that the expected return on a security is equal to the risk-free return plus a risk premium, which is based upon the beta of that security. According to the capital asset pricing model, therefore, we can express the expected return on equity as a formula according to which RE is equal to RF, the risk-free rate, plus the beta of the stock multiplied by the market premium, which is RM minus RF. What is the equity risk premium? It's the difference between the returns on equity or an individual stock and the risk-free rate of return. The risk-free rate of return, for example, can be benchmarked to long-term government bonds, assuming a zero default risk by the government. It is the excess return a stock pays to the holder over and above the risk-free rate for the risk that holder is taking. It is, in effect, the compensation to the investor for taking a higher level of risk and investing in equity rather than risk-free securities. And as you may imagine, if you look at the graph below, we see the x-axis, which is risk, and the y-axis, which is return. And as you can see, the higher the risk, the higher the expected return. So if we look at investment-grade corporate bonds, they are fairly low risk. At the other end of the scale, we have emerging markets equities, which will potentially have a higher risk. The equity risk premium has been estimated by using many major studies performed by academics and other researchers, by looking at the world stock markets, the US stock market, the UK stock market, and looking at these markets over a very period of many, many years. And the result of these studies is summarized here. Our estimate of a plausible forward-looking risk premium for the world's major markets would be on the order of 3% relative to bills on a geometric mean basis, while the corresponding arithmetic mean risk premium would be about 5%. We conclude that the market risk premium should be in the 4.5% to 5% range. Therefore, what we can notice is that the different studies reach slightly different conclusions, but most practitioners would agree that for developed markets, a risk premium of around 4 to 5% is a fairly solid figure to choose for performing valuations. The beta measures the riskiness of a specific stock relative to the market average. Therefore, by definition, the market has a beta of 1. And the beta of a stock is a measure of how its returns are related to the returns on the market as a whole. So the higher the stock, the higher the beta. Therefore, a stock which is more risky than average would have a beta superior to 1, and a stock which is lower risk than average would have a beta of less than 1. One of the interesting things we can note from this is that it is therefore possible, because betas are expressed according to the sectors a company is operating in. So, for example, one sector will have a beta of 1.2, another sector will have a beta of perhaps 0.8 relative to the index, is that we're able to use the betas, for example, the US market, and apply them in other markets because they are relative risks. In other words, if a software company is more risky than a power plant, it's more risky in the same way whether we're in the US or whether we're in Armenia or whether we're in Italy. And so betas can be used across different national borders. The cost of debt is normally a much more straightforward exercise than estimating the cost of equity. We can use the company's current cost of debt, which should be well known. If this is not the case for any reason, there are two other methods to estimate the cost of debt. One is to estimate the cost of debt relative to a risk-free benchmark and add a risk element for that company, or otherwise estimating the cost of debt by using historic debt and interest payments and dividing historic interest payments into historic debt amounts to obtain an average blended historic cost of debt. The components of the DCF cash flow, the cash flows to value, consist of two parts. Firstly, we have the cash flows for the forecast period. This means that for the forecast period, whether it be 3 years or 20 years, we are comfortable and able to forecast the cash flows on typically a year-by-year basis, and this is referred to as the forecast period. The terminal value refers to the fact that we know that the cash flows beyond the forecast period exist, and we have an assumption that the company will continue indefinitely according to the going concern principle, but we are no longer confident that we can estimate these cash flows on a year-by-year basis going forwards because it's not credible or it's too uncertain. And what we do is we make some assumptions about the cash flows beyond the forecast period and express those as a lump sum, which is called the terminal value, which we place at the end of year N, at the beginning of the end of the forecast period. In order to estimate the cash flows, we are going to make use of the accounting information of the company, and there are two cash flows to estimate. One is the cash flow to the enterprise, which is equal to the cash flow that goes to both debt and equity holders combined. That's one type of cash flow. The second type of cash flow is the free cash flow to the equity holders only. So the first one, free cash flow to enterprise, is equal to EBIT minus taxes calculated on EBIT, so they're not the actual taxes paid, but a pro forma tax amount, adding back depreciation, adding back, deducting capital expenditure, adjusting for changes in net working capital. This produces the free cash to the enterprise. Free cash flow to equity, we start with net profit and back depreciation, deduct capital expenditure, adjust for movements in net working capital, and adjust for changes in financing, and that gives us the free cash flow to the equity holders. We should clarify the differences between enterprise value and equity value. In the case of SMEs, what it simply means is that when we use an enterprise approach to valuation, we are going to be valuing the totality of the long-term capital, so both the debt and the equity capital. And the advantage of doing enterprise value approach is that we're able to work with higher level profitability indicators such as EBITDA. In the case of equity value, that means that our methodology of valuation will result in addressing the value of the equity only, which is usually the calculation we are looking for. In most cases, and in the cases of most SMEs, the simple connection between the two is that the equity value is simply going to be equal to the enterprise value subtracting the long-term debt. In the case of larger companies or more complicated situations, we may get more complexity in the calculation because it may be more difficult to identify what the long-term debt is, or the value of the debt may not be exactly equal to its face value. But for the purposes of middle-sized enterprises, this will be the basic calculation. How do we calculate the terminal value? Well, we make some simplifying assumptions, and what we tend to do is we tend to take the cash flow of the last year of our forecast and kind of assume that cash flow continues afterwards in some form. And one of the options is to assume that that cash flow grows at a certain rate, which we will set as equal to G, which is a reasonable assumption to make. And we are able then to discount these cash flows back to the beginning of the end of the forecast period, and the terminal value will be equal to TV equals to the free cash flow the year after the forecast period divided by R minus G. And we're able then to discount that back to today by taking that TV and discounting back to today, dividing by 1 plus R to the power of N.
Question 2. What is weighted average cost of capital, WACC? Please select 1. A is a model that describes the relationship between the expected return and risk of investing in a security. B is the difference between returns on equity, individual stocks, and the risk-free rate of return. C is the average after-tax cost of a company's various capital sources, including common stock, preferred stock, bonds, and any other long-term debt.
In this exercise, we are going to perform a basic DCF valuation exercise. And so we're going to be using both the enterprise value method as well as the equity method. In both cases, the steps are the following. The first step is you estimate the relevant discount rate that needs to be calculated, which we will use to discount the cash flow. In the case of the enterprise value method, you're going to estimate the weighted average cost of capital. In the case of the equity method, you're going to estimate the required return on equity. The second step is to go ahead and calculate the cash flows, and we do this by using the balance sheet and the income statement and using the formula for cash flows. So we're going ahead and calculate the cash flows. The third step is we estimate the terminal value. In our case, we're going to keep it simple, and therefore you should calculate the terminal value as being equal to the final year's cash flow in perpetuity. And then the fourth and final step is we perform the calculation. And in the case of the enterprise value, we will get the value of both the debt and equity combined, and we therefore would subtract arithmetically the total value of the debt to get the equity value using the enterprise value methodology. And then we could compare and see how close the answer for the total value of the equity is using both methods, and that will complete the exercise. We now move away from DCF valuation and we consider the methodology of relative valuation models, which basically refer to the fact that we try and value the company by comparing it to its competitors or other kind of comparable companies. Well, what is a relative valuation model? It is a business valuation method that compares a company's value to that of its competitors or industry peers to assess the firm's financial worth. It is an alternative to absolute value models, which try to determine the company's intrinsic worth based on its future cash flows discounted to their present value without any special reference to another company or any industry average. In other words, what we've just been seeing before in this module. Relative valuation uses multiples, averages, ratios, and benchmarks to determine a firm's value. This benchmark may be selected by finding an industry-wide average, and that average is then used to determine the relative value of the company. To be put more simply, it's no different to trying to sell your used car. If you have a used Ford Escort you want to sell, it's 5 years old, and you're trying to figure out what price you want to offer it at, what's the first thing you do is you go and look at what prices other used cars are selling by looking into trade journals and figuring out the different averages. You know, one may be 11,000 euros, the other one 10, the other one 9, and you think, well, I'll try selling my car for 10.5. It's really no different to that. The mathematical calculation is very simple. We choose a figure for sustainable earnings of the company, so an earnings figure of the company. We then multiply this by an appropriate price to earnings ratio, which we've derived by analyzing comparable companies, and from this we get the estimated value of the company's equity. One of the most difficult decisions to make is which earnings figure are we going to use in order to apply multiple to this figure to get the company's value. And there are a number of choices, but the two main choices are the price earnings ratio, where we apply a multiple to the profit after tax of the company in order to get its valuation. And one alternative is to use an enterprise value to EBITDA multiple, where we apply such a multiple to the EBITDA of the company to get an enterprise value, meaning a value which includes debt and equity. And then from the enterprise value, we can arithmetically subtract the debt in order to get to the equity value. And this is often much more popular, the second method, with private equity fund managers in particular, because they feel it's a more accurate measure of the company's value and of its operations. In using multiples, we may indeed use different methods simultaneously and compare the outcomes. The three enterprise value multiples most commonly used are the following. Enterprise value to EBITDA. It is very widely used because it's not distorted by depreciation or the company's leverage. So it's the purest measure of the company's industrial or commercial operations. Enterprise value to EBIT is also used, but it's distorted by depreciation. So for example, a company that is not a very good company, that has very old plants, so very low depreciation, may be overvalued by this. Whereas a company that's just made a big investment for the future may be undervalued by this because the depreciation will be very high. Enterprise value to sales. This is often used when we are talking about a loss-making business because they maybe have losses, so you cannot use a losses figure to apply a multiple to. So using a multiple of sales is quite effective when we're talking about loss-making business, or it could be in the large volume businesses, such as, for example, a supermarket chain. The main disadvantage, of course, is that it ignores profitability. Now, when we consider identifying and choosing comparable companies to get their multiples to apply to the company we're trying to value, we have a number of challenges. Firstly, we should note that there are two sources of this information. One is the stock market. We can extract information from companies quoted in the stock market. And the second source of information is the M&A market. We can extract information from companies buying other companies, even private companies, if the terms of these deals are announced and known. And the two main problems we face is, one, it can be difficult to find truly comparable companies because no one company does exactly the same as another. But generally, the principle we follow to resolve that problem is to follow the principle that it's better to use a moderate number of good matches rather than a large number of poor matches, which may distort the picture. When it comes to extracting information from the second source of data, which is the M&A market rather than the stock market, we do have certain challenges that may occur. The approach to analyzing comparable transactions in the M&A market is to identify a list of similar deals in the last year or so and analyze these deals, the range, the average and the median of the consideration paid, and express these as a multiple of assets, EBIT, EBITDA. The problems are that these comparable deals may be not so many, and secondly, there may be terms of these deals and complexities of these deals that are undisclosed, which may have an impact on the multiple, but we don't know about them. And so these should be used with a certain amount of caution, particularly if we think there is other things going on in these deals which have not been publicized. To give some preliminary conclusions on the two methods, so DCF compared to relative valuation, it must be noted that some investors will have a preference for relative valuation because DCF valuations can be very easily manipulated by experts in Excel by tinkering with some small adjustments on the discount rate or on the terminal value to obtain DCF valuations which can fluctuate very widely. However, this does not give a sufficient justification not to perform a DCF valuation because the exercise is very worthwhile in two very specific circumstances. Firstly, to reverse engineer a valuation to see the implicit assumptions. So it's not so much about creating the DCF valuation to get an answer, it's really to take the answer and work backwards to see what are the implied assumptions and whether these are realistic. And of course, valuations are not done in a vacuum, they're usually done for a negotiation, and if the other side of the table has developed a DCF valuation and you have not, you will be at a disadvantage. As you, of course, understand already, valuations are not done as a purely theoretical exercise. Almost all valuations of companies or banks are done for some purpose, involving a negotiation or some form of transaction. And therefore, it's important to see the valuations within the context of the transaction or the operation that may be going on. And a very good example of this, which we're going to use as a reading, is the valuation of Raiffeisen Bank International, which took place in 2014. And the context of this was that Raiffeisen Bank at the time was doing a rights issue, therefore a capital increase on the stock market. And this is a very interesting example of how we would value Raiffeisen, and we compare its valuation to its competitor Erste Bank. And these are two banks that are very active in Central and Eastern Europe, with which most people in the region are going to be very, very familiar. In this section, we talk about the approach to source and manipulate information that we need to perform valuations. And this skill, or the knowledge of this, is a very important opportunity for any advisor to a company to shine and provide a huge amount of value to the company. If the advisor to the company is able to perform a valuation which has depth and in which the inputs are well justified and properly researched, it will be a great source of value to the company, and it will give them a very strong hand in negotiations with a private equity fund. The private equity fund on their side will be doing exactly what is described in this section, and therefore it's important for any advisor to try and replicate that to some extent. And one of the important things to bear in mind is that there is the possibility to collect a very large amount of information entirely for free by making use of Google and other searches on the internet. And this is also exactly what the private equity fund will be doing at exactly the same time. And so it's important for advisors. And in emerging markets, we have a situation where information is not so easy to get by, and therefore the skill of working in an emerging market is the ability to A, find the information, and B, use information from more developed markets and adapt that information in order to be able to perform the valuation in the market that I'm working in. And so this section is absolutely crucial for any sell-side advisors. Let's examine the main sources of information that we can draw on to perform a valuation. One is the historical financial results, so the historical accounts of the companies, the last 5 years of income statements and balance sheets. That's one. Data available in the public domain, published newspaper articles, magazine articles, announcements, things that can be Googled. Thirdly, the stock market, looking at comparable companies in the stock market, looking at trading levels in the stock market. And fourthly, the management of the company, sitting down and talking to management and getting information from them. So 4 major sources of information. Firstly, historical financial results. In the case of a company that's public, in the sense that it's a quoted company or a company that's obliged by law or regulation to make its accounts available to the public, be it in the commercial court or company's house or on its website. And these are typically going to be annual reports such as the income statement, the balance sheet, the cash flow statement, although not always the case. But if there is no cash flow statement, it is possible to estimate the cash flow by using the income statement and the balance sheets at the beginning of the period and the end of the period. In the case of private companies, these are not obligated to provide their annual reports on the website or in any kind of publicly accessible agency. And in this case, public financial information may be looked for on databases. A database is a collection of information that is organized so that can easily be accessed, managed, and updated. In one view, databases can be classified according to types of content: bibliographic, full text, numeric, or image-wise. And obviously, the main issue with databases for any analyst performing evaluation is that there will be a cost to accessing these databases. Some of the sources of information. There are many sources of information available at different cost levels, some for free, some with an enhanced premium service where you have to pay for it. And these will include Bloomberg, which is global economic information, Capital IQ, which refers to annual reports, key ratios, M&A deals, Merger Market, focusing on M&A deals and company profiles, Factiva, giving the latest news on companies' performance, Preqin, publishing annual reports, Standard & Poor's, Moody's and Fitch, credit rating companies, Google, industry associations, and specialist sources by sub-industries. For example, for private equity, Cambridge Associates and Preqin are very big sources of information. One of the main skill sets for any good analyst is where to get information for free. The stock market is one of the fundamental capital markets that does provide benchmark information which we can make use of for valuation. However, we must also be careful. In the case of volatility, it's necessary to look at a market indicator over a period and eventually apply a kind of normalization. So we may have a temporary spike, as we saw in the crisis of 2008, where stock market prices were very volatile. And in this case, we would look at the performance of the stock market over a 3-5 year period and kind of smooth it over when we are using the information we want to use for the valuation. The second problem is that in smaller and emerging, less developed markets, there is an issue of low liquidity, which may distort the indicators which are on the stock market. We consider in this section the types of information available and the main challenges we may face in obtaining it for valuation exercises. Discount rates and yields. Information on stock market movements and other economic indicators is available from many sources, but one very good one is the Trading Economics website. We can find information on government bonds on Bloomberg. We can find information on bonds and statistical analysis and betas from the Financial Times and various other sources. Estimating the future equity risk premium. As we've seen, there are many studies that have been made, and historical risk premium in the equity markets is around 4 or 5%. But our approach should perhaps sometimes be more articulated. This difference between the return on equity measured by the return on the stock market index and the risk-free rate, as we know, is known as the equity risk premium or the market premium. This premium is usually calculated as a simple difference between the two, based on historical data for the period 1900 to 2000, for instance, which is a 100-year period, and using US Treasury bills as a risk-free investment. The equity risk premium was estimated to be about 7%, which is comparable to the 4 to 5% we saw earlier. There are basically three ways to estimate the future equity risk premium. We use as historical data, and we assume that the past equity risk premium is a good indicator of the future equity risk premium. We can ask experts for their opinion of the future risk premium and base our argument on the credibility of these experts. Or we can estimate the implied future equity risk premium from today's stock market using the dividend valuation model. Using historical data. This method takes into account past returns on equities and risk-free assets and looks at the actual difference. It assumes that the average equity risk premium that was earned in the past will be the same as investors expect to earn in the future. There is an assumption that the actual equity risk premium earned reflects what investors expected the equity risk premium to be before investing. In other words, the extra 4 or 5% that investors earned in the past by investing in equities rather than risk-free assets is assumed to be a reliable indicator of what investors expect today for the future. And in practice, that is often a correct assumption to make, with the exception being when one is going through a period of turbulence or high volatility, like for instance in the 2008-2009 crisis. Expert opinion. Another way of estimating the expected future risk premium is to ask the experts. For example, what do fund managers or academics think that the equity risk premium should be in order to compensate investors for the extra risk of investing in equities when compared with a risk-free asset? Such experts should know about the historic returns for estimating the future equity risk premium, but they may also have additional insights as to possible special factors to allow for in the future, for example, the impact of the 2008-9 global financial crisis. There is also a lot of so-called experts who have limited expertise but have a platform for communication, such as journalists and various panelists. The main question when choosing an expert is, should we choose a financial practitioner, like a financial manager who's working with real money and operating in the markets, or an academic? The advantage of the fund manager is that they have real money at work and they have so-called skin in the game, so that underpins the credibility of their opinion. But at the same time, academics who have wide knowledge and widely published, although not having put money at work, have a knowledge base that could also give them credibility. The third method is to estimate the implied risk premium. The third method of calculating the equity risk premium is to estimate the implied equity rate of return embedded in the current market price, given the forecast dividends to be paid on shares. To do this, the dividend valuation model is used. The dividend valuation model simply defines the price of a share to be the present value of all future dividends discounted by the required rate of return for that particular share. Having reviewed all the main issues in the previous sections, we now turn to a very vital section of this module, which relates to emerging markets and to all financial practitioners who operate in emerging markets. The main problem in emerging markets is that local information may be limited, and it may be a necessity to go and find information outside of the jurisdiction in which you are performing the valuation and adapting that for local uses. Some information can cross borders without any particular difficulty, such as betas, industry margins, and practices. Some information can be adapted for local use, and this is where experience and creativity are very important. The main rules to follow is to be careful not to mix apples and oranges and not to double count.
Question 3. What are the sources of information for company valuation? A. Historical financial results. B. Management of the company. C. Data available in public. D. Answers A, B, and C.
We will now go through a worked example from the Central Eastern European CIS environment, and this was an exercise that was performed in the year 2015 to estimate the required equity return for the country of Armenia. So, the Armenia worked example. Our objective is to estimate the return on equity, the expected return on equity for Armenia on average. And the challenge we have is that we have less reliable information for Armenia available than developed markets. In order to make this exercise realistic, the conditions that were put to the analysts doing this exercise was you could only find information that was for free using a Google search, and you had only 45 minutes to come up with an answer. The first three items that the Google search revealed were the following. Firstly, Armenia, the country Armenia, issued a Eurobond in the international Eurobond markets, and these bonds had a yield of 5.3% in nominal dollar terms. The second item of information was the inflation rate for Armenia, which was extracted from the IMF statistics, showing the inflation level that is currently operating in Armenia. And the third item we found was the current corporate interest rate evolution of Armenia over a certain period. The next three items revealed by the Google search were the following. The yield curve of Armenian government bonds. Armenian government bonds are not denominated in dollars, but in the local currency, the dram. And the yield curve was showing the yield of the government bonds according to the maturity duration of these bonds issued. So, for example, we can see in this chart that a 6-year bond had a yield of about 12% in local currency terms. The second thing the Google search revealed was a bond issued by the EBRD in the Armenian market with a maturity of 1 year, which had a yield of 7.5%. And the third item we found was a bond issued by the IFC, part of the World Bank, which was done into the Armenian market in local currency with a 3-year maturity, which had a coupon yield of 9.7%. Notice how that the yields on the coupons of the EBRD and the IFC bonds are significantly lower than that of the Armenian government itself. The final item that was found through the Google search was through the NYU Stern School of Business free website, and this was to express how to factor in the country risk into the calculation for the return on equity. Obviously, in the case of a more risky country, the following is observed, is that the equity risk premium is relatively higher. If you remember earlier in the module, the equity risk premium for US and developed countries was estimated at 4 or 5%. What the NYU theory tells us is that the equity markets are relatively more volatile compared to the debt markets in emerging countries, and therefore the equity risk premium should be somewhat higher. And the table on the right expresses that. We now get to the point that we can make our calculation for the expected equity return in nominal local currency terms for Armenia. If we look at the table in this slide, on the left-hand side, we have a collection of information that we have managed to obtain from the different data sources. The Armenia 7-year bond yield, 5.4%, the dollar bond in the international markets by the Armenian government, Armenian inflation of 5%, the Armenia official discount rate of 8.5%, the Armenia 4-year yield at 12%, Armenian government 7-year yield at 13.5%, the EBRD 1-year bond yield at 7.5%, the IFC 3-year bond yield at 9.7%, and the average relative standard deviation of equities to government bonds for emerging markets of 1.6. So let's go to our calculation. We start with the developed country market premium of 5%, which we got from the historical estimates that were made. We estimate the country risk premium for Armenia by taking the 13% of Armenian government bond yield and deducting the 9.7% of the IFC bond. The IFC, being the World Bank, has a AAA rating and should be considered risk-free, whereas the Armenian government is obviously more risky than the World Bank. And the country risk premium that we can extract or estimate is 4%. We then have to apply a factor of 1.6 because the 4% refers to the relative risk from a debt perspective. And we have seen that the equities are relatively more risky, so we have to make a further adjustment. we then are able to get the equity risk premium, which is going to be the 5% of the country risk premium, to which we're going to add the 4% of Armenia's risk premium multiplied by 1.6 to adjust for equities, and that gives me 11.4% for the Armenian equity risk premium expressed in local currency nominal terms. I then add this to the risk-free rate, which I will take to be the World Bank 3-year bond of 9.7%. Adding 11.4 to 9.7 gives me an expected equity return in Armenian local currency terms of 21%. So I can make a reality check that 21% I can compare, for example, to the Armenian government bonds of 7 years at 13%, which is something like 7% premium. I can compare it to the official interest rate of 8.5, and so forth. And so this is a way to use local information as well as international information to get to an answer which is coherent and defensible. What are some of the conclusions or lessons that we can learn from this worked example? Firstly, we need to use a little bit of lateral thinking to source information, and we don't necessarily have to pay for this information if we are creative. Secondly, we then mix local information with international benchmarks, and we have to do that in the right way. This has given us a result of about 21%. This is nominal in local currency. And this exercise that we've just performed, this worked example, is an essential skill set for any analyst working in emerging markets valuation. It is not the right answer to say the information is not there, I can't do it. It can always be done if you have the skills. Dealing with limited information is a typical emerging markets issue. The analyst working in emerging markets has to have a slightly different approach to the analyst working in developed markets. And the two key differences are the importance of primary research. We've already seen the importance of creativity. And secondly, the ability to talk to management and other people. A lot of the information is primary. In other words, it can be obtained by talking to people rather than sitting at a desk and using Google. One of the other things we have to mention is the attitude to giving out information is different across cultures. A relatively open culture like the Anglo-American culture, you find that managements are quite happy to talk to research outfits and analysts and provide information. Whereas in other cultures there's a lot more suspicion and it can be difficult to get such information. In this exercise we perform a simple relative valuation which hopefully will apply the concepts discussed in this section. What we have is a series of company results in one part of the material, which is sales, EBITDA, EBIT, profit after tax and so forth, a company metric. On the other hand, we also have a sample of some 10 companies which we have extracted from the stock market, let's say, in which we've extracted multiples of these 10 different companies. So the exercise consists in the following. The first step is to perform a valuation for each different type of metric of the company. So for each metric, firstly what we do is we look at the sample of comparable companies and decide what is the correct multiple that we should apply, and we're going to be looking at the sample of different numbers. We have to look at that sample and decide which of those numbers in the sample we might want to exclude because they're an outlier, for example, whether we want to use an average or a median. Having decided the amount of the multiple, we then apply it to the company metric and we get a valuation. We repeat this exercise for each of the different types of metric until we get 4 or so different results, and then we will then decide what is the correct value. One option might be to take the average of the 4 results we've got, which implicitly would mean that I weigh each of the 4 equally at 25%. Another approach might be to weigh some of the other ones more than others. So these are the instructions performing the exercise, and the outcome should be a value or a range of values which is coherent between the different methods. So far in this module we've covered the basics of valuation, so discounted cash flow valuation, which looks inside the company somewhat more, and relative valuation, which looks outside the company for external benchmarks somewhat more. We are now going to turn to the private equity exit-driven valuation approach. And the private equity valuation approach is not based upon a new technique, but it's really based upon the way the two existing techniques of DCF and relative valuation are used. Some of the key concepts and terms we will come across are pre- and post-money valuation, the hurdle rate, and the cash multiple. Like all good investors, private equity fund managers are rigorous, and the analytical approach of the private equity fund does require the development of an important, robust, and credible financial model. The approach to the valuation is basically driven by the policy of the fund manager to seek an exit for his investment in the medium term, 3 to 5 to 7 years. And the way the valuation is enhanced is in two ways, according to private equity methodology. We increase the metric, in other words, we increase the size of the company, but we're also going to be increasing the multiple, because the nature of the company is going to change significantly during the period of the forecast. And this is the essential difference with classical corporate finance, which make an implicit assumption that the nature of the company isn't changing radically. It may grow, it may go up, it may go down, but it's not changing radically. In the case of private equity, we're increasing the size and we're increasing the quality. Let's review some of the key terms or definitions which are going to be coming up in private equity in their approach to valuation. Firstly is the concept of the pre-money valuation. This refers to the value of a company before the capital increase from the private equity fund goes in, and one of the implicit assumptions of the pre-money valuation is we're kind of valuing the company as if nothing was going to happen with the private equity fund going in. So what would be the value of the company if it just stayed as normal? The post-money valuation is the value of the company right after the private equity investment has been made. In other words, now the company has access to these private equity resources, and what is going to be the impact on its valuation after these resources have gone into the company. Money out is the amount of the private equity investment which is going into the pocket of the shareholder for his or her own uses and pleasure, rather than being put to work in the company, and that is a part of any private equity deal, although most PE funds would prefer most of their money to go in as money in. Money in means is the amount of private investment that's going to be actually put to work in the company, usually taking the form of a capital increase. The hurdle rate is the target return of the private equity fund, and this the amount of this return can vary, but it's what they promise to their own investors. And the cash multiple refers to the amount of cash that the private equity fund will get when selling the company compared to the amount of cash they put in at the time of the investment. So it's a simple arithmetic ratio. Let's start the discussion on private equity valuation by making a very, very simple example which summarizes the approach, which we could call the basic approach to valuation. We've seen that the pre-money valuation refers to the value of the business before the money goes in. So let's say the entrepreneur owns business ABC and the venture capitalist is planning to inject some money in the company because the entrepreneur, the owner of business ABC, thinks with $1 million he can make this company much more successful. So if business ABC is worth 4 million before the venture capitalist injects 1 million, the investor will be entitled to simply the arithmetic calculation 1 divided by 1 plus 4, 20% of the shares of the company, which would seem the natural calculation to make. However, that's not the whole story, because what this calculation doesn't do, it doesn't show or reflect how effectively this 1 million is put to work in the company and how this 1 million can contribute to increasing the value of this company in the future. And we get this by using a future post-money valuation discounted back. And how do we do that? Well, the private equity manager makes a financial forecast which he develops, assuming that the 1 million is injected into the company. He models in his forecast the way this 1 million is put to work and the impact it will have on the company, increasing the working capital, new investments, and this will allow the company to grow. And the likely resulting value of the business in 5 years is estimated, and this value is then discounted back. So let's say business ABC is estimated by the venture capitalists to be worth 50 million in 5 years. In other words, the 1 million has been put to work and has done a great job, then the venture capitalist will discount back this 50 million in 5 years from today at 35% a year, which is his own in-house internal target rate of return, and that gets me 11 million. It's 50 divided by 1.35 to the power of 5, and therefore I would actually be happy to only have 9.1% of ABC because my money's been put to work, and the value of the post-money valuation today, according to this alternative method, is 11. So notice that there is a difference between a post-money valuation, which is the static method, which is 5 million, and a post-money valuation according to the dynamic forward-looking method, which is 11 million. And therefore, it's obvious to see that the negotiation will therefore be in the range of 9%, which is the minimum amount the venture capitalist will accept, to 20%, which might be what he manages to negotiate according to the static approach. Let's now build upon this simple example and understand what's really going on from a private equity perspective. And we start with the concept of double vision, also known as travel in time. A private equity investor looks to exit. If I'm going to exit one day, this has to be someone else's entry. For me to exit, somebody else has to enter. And therefore, a private equity investor will look 3 years, 5 years, 7 years to the exit point and visualize the company at that point, because whoever buys at exit will themselves be looking 3-5 years in the future as well. And so we need to take a second look and visualize what a future buyer will see in 3-5 years down the road. Now that does sound difficult. It does sound a bit like using a crystal ball, but private equity fund managers are on average better than the average member of the financial community at doing just this exercise. That is their job. Private equity refers to the phase of companies when the growth is very young, and we saw earlier that that is one of the reasons that classical financial theory, doing an approach of valuation using the classic DCF or classic relative valuation methods, does not work. Why? Because when a company is young, we have a lack of metrics. If the company is not making profits, we can't apply a multiple. If the company is a venture type investment, it may not survive. And one of the implicit assumptions of financial theory is the going concern assumption, that the company will continue to go forwards. And thirdly, there is a lot of firm-specific risk in the portfolio, whereas in classic financial theory, there was an assumption that company-specific risk is diversified away by investors, and that's not the case in venture capital, for instance. Let's once again recap the PE valuation technique that we saw in the simple example a couple of slides ago. Step 1, estimate earnings or revenues at the end of the time horizon based upon a financial plan which assumes that the money that I've injected in the company has been put to work. Step 2, I apply a relevant multiple to the revenue or the earnings figure. I get this multiple from comparable companies just as I would in a normal relative valuation exercise. Step 3, I discount back this value at my target rate of return as a PE fund manager. Now this rate is higher than you might have noticed for the expected return on equity using the beta formula, because this rate has to be higher because it must encapsulate the risk of non-survival and other higher risks which refer to younger companies. And this rate is normally taken to be the rate that the private equity fund manager has promised his own investors to generate in his investments. Step 4, the valuation obtained is then used to estimate the proportion of the firm the VC should own in exchange for his equity injection. We now give an example of a private equity approach to valuation, and in particular the uses of a private equity approach to valuation by private equity funds. Let's return to our company ABC, in which the private equity fund plans to invest $1 million. We make the financial plan assuming the 1 million is invested and put to work. And let's look at the forecasts contained in this slide. And the figures will show a very typical expansion type investment. So what we can notice is that we see a rapid sales growth which slows down towards the end of the forecast period. We see a lower profitability in the early years as the business is built up, and then steady margins over time. So by the time we get to year 5, the rate of growth of sales has slowed down, and EBITDA as a percentage of sales and profit after tax as a percentage of sales have stabilized at a high level, and this means that the company is ready to be exited. So let's look at our worked example from a slightly different angle to show the uses that can be made of the private equity approach to valuation. Let's assume the fund has a 15% stake, that profit after tax in 2020 is 5 million, and that we believe the company can be sold for price earnings multiple of 10. This means that if I own 15%, the proceeds I get will be 5 million multiplied by 10, multiple of 10 times my 15% stake, which means 7.5 million, being my share of the sale proceeds at the moment of exit if I own 15%. The investment at the beginning is 1 million, and therefore I can then calculate what my return will be. If I solve the formula of 7.5 divided by 1.r to the power of 6 equaling 1, this results in r equal to 40%. And therefore, if I'm able to sell the company for 7.5 million, and I've invested 1 million, I can earn a 40% return. And I repeat this calculation for a range of scenarios. What we notice here is that it's important for the PE investor to make a very detailed consideration of the exit point, because the company is unlikely to have any free cash flows during its forecast period, and so he gets all his money back at the moment that he sells the company, not much before that. So it's normal that a lot of attention should be put into the exit moment. And so what are the variables that will generate our returns? It's how much of the company I get to own, how much I can sell for the company for, the exit multiple, the price, and what the actual metric, the expected figures of the company would be, the expected profit after tax. So if I look at this, if I only manage to negotiate with the entrepreneur to own 10% of the company, and the company ends up making a profit of only 4 million and is only sold for 9 times profits, then my return will be 24%. If I manage to negotiate a 20% stake, we manage to sell the company for 6 times profits, and the profits for 11 times profits, and the profits turn out to be 6 million, I can get a 54% return. So what I'm really showing here is sensitivity tables looking at different scenarios. And this is very common for private equity investors to look at these kinds of scenarios to see what their downside risk could be. We now perform an exercise of an exit-driven valuation. So we are presented with a company. All the numbers have already been calculated. And the job of the analyst is firstly to choose which is the best year to exit the company, and having chosen the best year to make the exit of the company, in other words, which gives the best price, is how much of the company do they need to own in order to get their target return, which is an important benchmark you need to have in mind before you go into negotiations. Now, what we've seen before, just now in this module, is the valuation of the whole enterprise, looking at it as a whole. However, private equity fund managers will often make their investments through different types of financial instruments, and some of the structures of private equity deals may have complexities. And so this will have an impact on the valuation, and this is what we're going to explore in this section. So turning to the valuation of financial instruments. The fact is, any investors interested in a company is held through a financial instrument. And therefore, ultimately, if we're valuing this interest of an investor, we ultimately have to value the financial instrument. Obviously, this will derive from the value of the company. Financial instruments in private equity will include ordinary shares, preferred shares, mezzanine debt, options and debt, or some combination of these. IPEV guidelines are an important source of guidance for valuation in private equity, particularly as it pertains to financial instruments. IPEV stands for International Private Equity Valuation. IPEV was set up in 2005 as an independent association by participants in the private equity industry. It has its headquarters in London. Its mission is to provide high quality, uniform, globally acceptable, best practice guidance for private equity and venture capital valuation and reporting purposes. The main publications by IPEV are the Valuation Guidelines and Reporting Guidance of 2012, then supplemented by further publications in the subsequent years. IPEV's work has been endorsed by most private equity associations and thus is credible. IPEV as an organization has 4 principal objectives. The first one, which was historic, was to harmonize the various initiatives that were taking place in the private equity industry on the topic of valuation and reporting, with the idea that instead of having competing standards, it would be best to try and merge these into one single body. Second objective is to provide LPs and GPs with a common set of principles for valuation and reporting. The third objective is to increase transparency in the private equity industry. Private equity industry is a notoriously non-transparent industry. And fourthly, it provides principles that are also compatible with IFRS and US GAAP accounting standards, as well as other previous comparable initiatives of valuation and guiding. So harmonization, common standards for investors and fund managers, increased transparency, compatibility with accounting standards. One of the main valuation principles is the concept of fair value, and this is applicable not just to IPEV but more generally. And fair value is defined to be the price received by the seller of an asset in an orderly transaction on the measurement date. It assumes the transaction takes place in the principal market or the most advantageous market for the particular asset, in the case of the asset being traded in several markets. For quoted investments, the available market price on the stock market will be the basis of fair value, assuming that stock market doesn't have any specific problems with liquidity or volumes. For an unquoted company, the valuer is required to assume the instrument is realized or sold at the measurement date and allocated to the various interests or ownerships. For investments in multiple securities or rounds of financing, the valuation should be made based upon whether it's reasonable to assume a transaction would result in the aggregation of the securities or not. The IPEV valuation principles are, again, in some sense, self-evident principles and shared by many other valuation practitioners. So the fair value should be assessed at each measurement date because valuation can change over time. The valuation technique should be appropriate to the investment, and the portfolio should use reasonable current market data combined with reasonable assumptions. And the fair value estimated should be based upon the perspective of market participants and market conditions at the time of data measurement. In the case of a private equity valuation, what are the main steps in doing a valuation? Well, IPEV recommends starting with determining enterprise value, then make adjustments for factors such as surplus assets, excess liabilities or other off-balance sheet type contingencies. Then deduct from the adjusted enterprise value any higher ranking financial instruments than those of the fund and allow for a potential dilution by any other further instrument. Then apportion the attributable enterprise value between the financial instruments after the higher ranking ones have been deducted, and apportion this value according to their ranking. Then allocate the amounts according to the fund's holding in each instrument. And a calibration check is to use the method at the date the investment was made as a check. So in other words, if the investment was being valued using a different method at the time investment was made, use that method as a reality check to the method being used at the current time. Judgment: the valuer should consider economic substance over legal form. In other words, in the case, for example, that we have a special vehicle through which the company is held, you have to look through the vehicle and value the actual economic assets of the company rather than the nominal value of the special vehicle. If there is a currency conversion, one uses the bid spot exchange rate at the date of the measurement. For techniques of valuation, one benchmark could be the price of a recent investment in the company. It's possible to use the price of a recent new investment in the company for a limited period following that particular transaction. Using multiples, the multiple should be appropriate given the size of the company, its risk profile, and applied to maintainable earnings. In other words, not earnings which contain one-off items. Other method is to use net assets, a DCF of the underlying business, or the discounted cash flow of the financial instrument itself, which tends to apply more to instruments with debt characteristics. Other benchmarks could be industry valuation benchmarks, so non-financial benchmarks like per value of hectolitre for a beer company or per value per subscriber for a telecoms company. These are likely to be the main base of valuation only in very limited situations and should only be used as a reality check in the case of an IPEV valuation. In terms of available stock market prices, the practice is to use the price on the measurement date, but has to make with the possibility of making adjustments from loss of meaning, from low trading volume, or eventual discounts if there is some legal restriction attributable to the security. For example, that foreign investors can't invest in it or something like that. Funding rounds, particularly in venture capital, the different funding rounds may be a clear indicator of the value at the date of investment. In venture capital, it's quite common to see funding rounds of so-called Series A, B, C, and so forth. And certain circumstances may reduce the reliability of a funding round. But for example, if it's only the existing investors in the same proportion as existing investments, then that may reduce the meaning. If an existing investor financing is done at a lower price, that may indicate a decrease in the value of the company. Sometimes a funding round may be pumping up the value to set up a subsequent later investor. The down rounds, inside of down rounds, in other words, around a lower valuation, may have different forms. It could be converting preference shares, combining classes of shares into a smaller number of shares, cancelling shares before capital increase. One thing one should note in discussions with the company, that the board of directors of the company has a fiduciary obligation to set the price of any newly issued shares at a fair value as a matter of the company's best interest, even if that board member may be from a specific investor. One of the IPEV considerations is a distressed market. So if a transaction takes place in a distressed market, an adjustment to the valuation may be necessary. Some of the factors making for a distressed or non-orderly transaction include the legal requirement to transact. So for example, a bank may be ordered by the central bank to dispose of a certain number of subsidiaries, and that's a legal requirement. Or the need to dispose of an asset immediately without enough time for a proper sale, so a so-called fire sale. Another example could be only one buyer. For example, if one has a put and call arrangement, there's only one buyer, that buyer knows it, and therefore could have more leverage over the price. The seller is distressed, so the company is not distressed, but one of the shareholders is personally distressed for some reason, and that may also be non-orderly. Not enough exposure to the market to permit customer marketing and due diligence. It could be that the asset requires a lot more time because it's customary to do a certain amount of marketing and this isn't possible. Or finally, the transaction is generally considered an outlier by most market participants when compared to similar transactions, which would suggest there's something going on in the circumstances of this transaction which makes it non-orderly. Higher ranking instruments. Well, many private equity structures, such as acquisition structures and leveraged buyouts, will include a debt which ranks higher than the equity interest of the fund. And in many cases, this financial structure can be quite complex, where we have senior debt with security, second lien, so debt that has a second claim on a collateral, mezzanine, which is an unsecured, generally tends to be an unsecured debt, preference shares, which may have some debt characteristics, for example, in the case of them being redeemable, and ordinary shares. And so the calculation of this enterprise value needs to take into consideration any repayment of third-party instruments. For the debt, particularly senior debt, it's more simple because one can tend to look generally at par or at the market value of the debt in some circumstances. Bridge financing refers to a short-term temporary loan ahead of a different financial instrument coming into play. So funds may grant loans to an investee company ahead of a new round of financing, perhaps because the company is in a hurry to receive the money and it takes some time to organize this new round, and it's understood that the new round will serve to repay in part the bridge financing. So it could be ahead of an investment by a fund, or it could be a follow-on investment by a fund after a round of equity investments. There's a follow-on bridge financing because the money has to be supplemented. If the fund doesn't hold any equity investments in the specific company, which is unlikely in practice, then the cost of the bridge financing or the par value will probably be the best indicator. If we have a situation where the fund is an investor in the company through equity and the company has difficulty refinancing the bridging loan, then the value should be reassessed and it should be looked at more as an equity investment. If the financing is provided by the fund ahead of an investment, then the bridge finance should be simply valued together with the original investment if it's reasonable to assume the intention was that the investment would be combined. One other scenario might be in the case of bridge financing where the round investment doesn't materialize because there are problems, then that bridge financing should also be valued as equity. The valuation of mezzanine finance is an area of particular interest because it is a common source of debt finance in private equity. It ranks below senior debts, but it ranks above shareholder equity or shareholder loans. It tends not to have collateral, though in some emerging markets funds that's not the case, and it often has warrants attached. Usually the mezzanine is provided by another specialist institution, such as a mezzanine fund, rather than the equity provider. And in this case, it would need to be valued on a standalone basis. As the loan tends to be secured by cash flow rather than collateral, the value of this loan is much more sensitive to the changes in the business. If the cash flow deteriorates, the value of the loan deteriorates because the possibility of repayment is lower. So the valuer should consider if changes in the required yield have occurred, which will impact the valuation. Most commonly used is a DCF calculation, where we just simply look at the principal and the interest payments on the mezzanine instrument, although there may be some complications if part of the coupon payments is linked to profits, for instance. In case of the warrants attached to a mezzanine, the valuer may consider using some kind of option or warrant pricing model, especially in the case of the call option not being in the money, so being out of the money, which means the time value of the option would be the main source of value. And another thing to look at would be change of control provisions. If the loan is repayable and that's triggered by some kind of provision, that would mean the tendency would be to value the loan at par. Some instruments may have rolled up loan instruments characteristics, and so what they would do is they would accrue interest payable only upon redemption, so very similar to a zero coupon bond or payment in kind notes. And they may have other enhancements like step increases in the interest rate. And typically these kinds of instruments would be very linked to the underlying equity investment and would themselves be redeemed completely on exit. And therefore, in order to estimate the yield of these as loan products, one should take the recoverable amount, estimate it at the moment of exit, and then spread it over the life of the instrument in order to generate a constant yield for valuation purposes.
Question 4. What means double vision in private equity? Please select all relevant answers. A. A PE investor ultimately looks to exit. B. To provide high quality, uniform, globally acceptable, best practice guidance for private equity and venture capital valuation and reporting purposes. C. Your exit is someone else's entry. D. Techniques should be appropriate to investment and portfolio, should use reasonable current market data combined with reasonable assumptions.
In this exercise, we consider the case of a company which has 2 or 3 classes of shares, ordinary shares, and 2 classes of preference shares. And what we are trying to do is we have a valuation of the company as a whole, of the total equity of the company. And what we're trying to do here is we're trying to understand how to spread that valuation among the 3 classes of shares, and we're going to explore some of the complications of that. This is a common scenario you might find in venture capital, where ahead of an IPO or a strategic sale, the 3 different classes of shareholders have to reach an agreement on how to spread the value, because they're going to be merging those shares into one single class to simplify their capital structure for the IPO. We then repeat the exercise in a more complex scenario of 5 or 6 categories of shares, and we see what are the objective limits in the possibility of apportioning the value among the classes of shares and whether the class of shares have got so complicated that it becomes challenging or extremely difficult to do so. Having reviewed the different types of financial instruments and how these are valued and some of the complexities of that, we now consider the challenges of valuing within deal structures, because private equity deals can be complex and the structure of the deal may have an impact on the valuation of any financial instruments. In some cases, it's a question of trying to understand the deal structure and making considerations about it, and then using that the conclusions from that consideration to adjust the deal structure. In other cases, it may be even more complicated, because it may be necessary to estimate future outcomes of events and contingent events and their impact on the valuation today, and estimate the probability of these future events, or whether we can simply ignore them. And in one of the main important things to take into account when doing private equity valuation is to beware the facile use and superficial use of majority premiums and minority discounts, which is often used in investment banking. This is always a wrong approach, because the premium percentage and the discount percentage are always plucked out of thin air and totally arbitrary, and they have no place in private equity valuation. Indicative offers. Sometimes indicative offers from third parties, such as an industrial buyer or another private equity fund, these offers can be taken as an indication of the fair value of the underlying business. The idea being that the business was looked at by an intelligent observer with a potential financial interest to acquire the business, and therefore the valuation is a good indicator of value, and I can rely on that. However, there are some very significant caveats. Firstly, the valuer should consider the motivation of the party making the offer. It could be a high offer to open negotiations, so the party offers high with the intention of negotiating downwards. It could be an offer just to gain access to the company and do a little bit of market study with no real intention to conclude a deal. It could be an offer which is made subject to strict conditions or future events, so the company meeting its forecasts, and if it doesn't, the offer is revised downwards. It could be a lowball offer because the offerer is acting speculatively and thinks the seller is in a distressed or difficult position and just throws in a lowball offer. Or it could be one of the shareholders trying to take advantage of the poor liquidity position of a fellow shareholder to get some shares much more cheaply. And these will all have the effect of distorting the fair value. Another thing to look out is if an offer is made with insufficient detailed information, one should assume that it's less serious. Another thing to look out for, the offer may not be real, it may be orchestrated by another stakeholder for their own motives. So one of the shareholders may get a third party they're connected with to put out an offer that seems from a third party in order to try and shake the trees and buy out one of their own shareholders. It could be an offer made by a party on behalf of someone else, such as a money laundering. So generally, a valuer under IPEV standards cannot draw a firm conclusion. The indicative offer should always be used in combination with all the other methods. Impacts from structuring. So as mentioned before, briefly, some private equity investments may have complex structuring with different groups having different rights, which will impact the valuation. So it could be that there's a Series E share with automatic right to nominate 2 directors, and that will have an impact on the valuation. The valuation should also take into account the impact of any future changes which may impact the investment structure. The changes may happen by the choice of one of the investors. It could be done automatically based upon some trigger event, such as a company results, or at the option of a third party. These rights need to be reviewed on a regular basis, and the rational assumption to be made by the valuer should be the cost-benefit test. If the benefit of exercising the right is superior to the cost, it should be assumed the right will be exercised, and therefore that should be considered in the valuation. Examples of deal structure elements which may impact the valuation may be stock options and warrants. These are basically off-balance sheet items which, if exercised, will impact the valuation. Anti-dilution clauses. So in the case the company does a down round or does a financing at a lower price, this may trigger changes in the relative value of different share categories. Ratchet mechanisms, meaning if the price of the shares or the value of the shares is linked to some future profits, It could be convertible debt present, so if the debt is converted, the equity holders will be diluted. It could be liquidation preferences. In the event the company is liquidated, certain shareholders will have preferential rights. Or it could be so-called pay-to-play, which means there are commitments, firm commitments by certain shareholders to subscribe to follow-on capital investments. Aside from the type of financial instrument and deal structuring instruments, there also may be contractual rights, frequently found in M&A type transactions, and this means the consideration or the payment for the company is dependent on a future event. In M&A, it's known as contingent consideration. And what this does is that it structures the deals and creates a lot of uncertainty because a lot of the value will be based upon the outcomes of future events. Buyers then can delay fully paying for the value until these future events are crystallized. And so the best approach to valuation is to use a DCF using some kind of probability weighting scenarios. And within that, decompose the factors which will lead to the contingency happening and apply those scenarios. To avoid misapplication of accounting principles, the best definition for this is contingent consideration. All valuation involves a calculation to different extents. So, and all valuation, we might make use of Excel spreadsheets to estimate forecasts and cash flows. And these would be arithmetic type of calculations, such as a discount rate calculation and so forth. And this is not what is meant by mathematical model here. All valuation work does involve basic arithmetic. But when we're talking about mathematical models, what we're really talking about is complex mathematical models to do high-level, sophisticated valuations, such as option pricing mechanism, which would use the Black-Scholes-Merton formula, which is highly mathematical. And these mathematical models are used mostly in fixed income and commodity and derivatives markets, but they don't really have any place in private equity. Although it has happened, there have been some attempts made to use option pricing models or probability weighting return models in Excel to estimate early stage companies, but this is at best experimental. These models are also used for distress situations, but this is not something that we're going to be covering in this module. And therefore, mathematical models should not be considered at this point, particularly when it comes to the mid-cap market. In this exercise, we consider 3 different deal structures in private equity, and within these deal structures, we're required to try and value a class of shares, and this is a good exercise putting in practice some of the concepts we've just discussed. Like any method of valuation, the private equity approach will have its own drawbacks. One thing is that there is a focus on some limited metrics, and that will encourage game playing, because what we're looking at is the profit at the moment of exit, the multiple, and the discount rate of the fund. And that means the projections can become a bargaining issue instead of the subject of a well thought out financial estimation. Another thing is that we are using the multiples methodology at the exit point, and so there's limited attempts to forecast longer term beyond the exit moment. The use of the target discount rate could be argued to be a little bit superficial, unlike in financial theory, where we can estimate a discount rate based on some theory, on a beta, on a risk-free rate, on a cost of equity. The target discount rate of private equity funds is based upon what they promise their own investors, and it's ultimately derived on an empirical basis. And so that could be argued to be somewhat superficially. And another thing is that we would know intuitively that in the case of private equity investment, the company is much more risky at the beginning of the investment period than at the exit. So theoretically, we should reduce the discount rate every year as the company's risk profile decreases, but we have no financial theory that allows us to quantify that, so we're unable to do that. To summarize some of the challenges in private equity modeling, well, in corporate finance and private and project finance models, the terminal value is a smaller percentage of the total value. And so these models tend to use a projection of the final year cash flow with some growth assumptions. Sometimes it's a 2 steady growth period and then a GDP growth ad infinitum. In private equity valuations, we've seen the terminal value needs to be much more articulated, and the best approach is to create a kind of table of values depending on scenario. So let's summarize, let's compare a financial model of a project finance, with a financial model of a classic corporate finance referring to a mature company, with a financial model referring to a late stage venture or a growth type investment, a private equity type investment. So in terms of forecasting revenues in project finance, the revenue stream is fairly stable depending on the contractual arrangement. In classic corporate finance, we can project off historical data with some growth assumptions. In private equity, we have to look at other firms in the market and make assumptions about the company's growth and sales, which is more uncertain. The cost structure in project finance is fairly structured. In classic corporate finance, it's going to be based off historical precedents with adjustments. In private equity, it's going to be changing rapidly as the company evolves, so we have to look at other firms' cost structures and assume that the private equity investment will gravitate towards those cost structures. The capital structure in project finance is fixed, although complex. In classic corporate finance, it's also more simple, with the main change being the debt-equity ratio, how much debt to equity there is in each particular year. In private equity, it's the most complex, where we have different ranks of equity. It's evolving. There may be further rounds of financing. Capital injections in project finance, not generally, nor in classic corporate finance. In private equity, we may have to model in further capital injections or further rounds of equity financing. Free cash flow in project finance is stable. In classic corporate finance, it fluctuates with the company's evolution. In private equity, it's pretty much close to zero or very low. The terminal value in project finance is almost irrelevant because it's such a small part of the project, particularly with the long-dated forecast of 25 years you might see in a power plant, for instance. So we use perpetual cash flow. Classic corporate finance, we might use a two-step. In private equity, we have to put a lot of energy and thought into it and use exit scenarios. The discount rate in project finance and classic corporate finance is going to be the weighted average cost of capital. In private equity, it's going to be an empirical number, which is based upon the fund's target returns. And this concludes the valuation module.
Question 5. What are the drawbacks of the private equity approach to valuation? Please select all relevant answers. A. Projections become bargaining issues rather than the subject of well-considered estimation. B. The hockey stick. C. The use of target discount rates is somewhat superficial. D. Focus on some limited metrics encourages game playing.
So finally, I would like to express my thanks to the World Bank for allowing me to share a version of the course that I developed with them and put it online on my website, on my LinkedIn profile. So thanks for that. Secondly, all the modules, this module and all further modules, will have a certain amount of case studies and additional materials attached to the module, which are part of the learning experience. These materials I will be posting on a specially created group that I have made in LinkedIn called Gavin Ryan PE Course. All you have to do is search Gavin Ryan PE Group and the group will come up for you to join. You who are following this course, you'll be eligible to join my group and get these additional materials once you've connected to me on LinkedIn and once you've subscribed to my YouTube channel. So when I receive a request to join this group, I will check these two things and then I will admit you to the group. So thank you very much for your attention. I hope you've enjoyed this module and I look forward to seeing you on the next module.